All right, so today we're gonna talk some more about SUDA and this experience rating system, which helps to determine. We talked, kind of introduced on Tuesday, the fact that the tax rate or the rate that is assigned to employers is going to depend upon several factors. One of those factors is how many claims have been made against the unemployment pool by that employer. And we're going to talk about this experience rating system, which is a calculation that states will use to help determine what the future tax rate is for employers going forward for the next year. So we'll go through a problem that shows you how that works. Then we'll take a look at the 940. So we're pretty familiar with the 941 form, which is the quarterly report that is sent in for federal income and FICA taxes. There is a similar form called the 940, which is what is used by employers to report their FUTA taxes. It is just an annual form. It's not quarterly like the 941. We'll take a look at what that form entails, and we'll look at it kind of line by line. You do have some homework problems where you're required to fill one out. So then we'll also take a look at the Iowa quarterly form, just to kind of introduce you to what it looks like and what type of information is on it and how that is represented. So after that we're kind of, that's about it for chapter 5. So what we're going to do next Tuesday is do some review of some homework problems. So if you have some that you want to go through, you need some extra help on, maybe take a look at those before next Tuesday, and you can bring them in on Tuesday and we'll take a look at them. I will put together a chapter 7 practice quiz, and then I want to start just kind of taking a peek at that chapter 7 final payroll project. If you guys haven't opened it up yet and taken a look at it, it's completely different from the homework, how you've been doing the homework prior. So I wanted to kind of get you introduced to that and what's going to be required for that. So that's next Tuesday as well, and then that'll be it for chapter 5. Okay. Any questions before we get started? Okay. All right. So let's talk a little bit about this experience rating system. Again, what it does is it's a calculation that helps the state to determine what the contribution rate should be in the coming year for employers, and it is based on prior contributions, how much the employer has contributed into the fund, benefits that have been paid out, and then it's compared to, there's a ratio that's used that also includes their average annual payroll. So again, this is called the reserve ratio formula. Once you get that reserve ratio amount, then the state will apply it to whatever table they have put together. Now, in the problem that we're going to go through, they've given us a table that can be used, but that's not necessarily, that's just an example of a possible table. So each state is going to have their own reserve ratio table. It may change from year to year as well, but you apply the percentage that you get, or the reserve ratio that you get to that table, and then it gives you the tax rate or the contribution rate for the employer for the coming year. If there's a positive balance in their account, so their contributions to the fund exceed their benefits paid, obviously that means they've got a surplus in there and their tax rate is going to go down for the next year. If the opposite is true and there's a negative balance, so contributions or benefits paid exceed contributions that have been received, then their tax rate is going to go up in the future. So that's kind of how that all shakes out. Where's my, here we go. Sorry, now I lost my spot. There is a way for employers in some states to make voluntary contributions into the fund in order to reduce their tax rate or their contribution rate going forward. Obviously, if you increase the amount of contributions, that means it's going to bring you more into a positive balance, or it will reduce the negative balance and will give you a lower rate going forward. So they're going to pay less in SUTA taxes going forward. Now, employers would want to make that calculation to determine whether or not it's worth it or not. So like if they pay an extra $1,000 into the fund, is it going to make enough of a difference in their future contribution rate to reduce their taxes at least by $1,000? You know, they want to do a cost-benefit analysis on that to see if it's worth it. And the problem that we're going to take a look at will show how that voluntary contribution would affect the tax rate going forward. So as far as employer liability, so an employer will remain liable for up to 2 years. So even if they go out of business, the business itself would still remain liable for any future claims against it. And an employer has to file an application with the state in order to terminate their liability. There is an option for nonprofits to directly reimburse the state for the actual amount of unemployment benefits that have been paid out instead of making those SUTA payments, having it spread out. So instead, if somebody files a claim, they just directly pay the state for the benefits that are coming out. One thing that businesses have tried to do in the past, because I mean, when we're talking about taxes, obviously there are ways to manipulate the system, both legal and illegal, to try and reduce the tax burden. There is this SUTA Dumping Prevention Act. So SUTA dumping would be when a business voluntarily or intentionally closes down operations in order to prevent filing of liability of for unemployment taxes. Like maybe they want to reduce their rate. So maybe new businesses have an automatic rate of 2% the first year. And so because there is no history to go on, but they've been at a 7% rate, they close down operations, close down the business, and then start a new business. So they get that 2% rate the next year. There is there is legislation that helps to deal with that type of fraudulent activity called the SUTA Dumping Prevention Act. It's not the most, the name of it is a little, I don't know what the word I'm looking for is. Okay, so what I want to do is give you an example of how this reserve ratio works. You have a problem in your homework that is very similar to this. It's not exact, the numbers are a little bit different, but it's very similar, so you can kind of follow along. There are several steps. Well, first off, I want to put the reserve ratio up. So our reserve ratio is calculated by taking our contributions minus benefits paid divided by our average total payroll. Now, in this problem, you've got to calculate out what the contributions were. You've got to calculate, well, actually, I think they give you the benefits that have been paid out. But then you also have to calculate what the average total payroll is here. So the first step that you want to do, step 1, is calculate the contributions. All right, so let's read I just put this problem up, by the way. There's not a connection to this through Canvas, there's not a link, but it's in Cengage if you wanted to look at it. It's just a single problem There's no points for it, but it just says, I think it's entitled Reserve Ratio Practice, okay? All right, so we've got Alfaro Security Company located in state H. They enable employers to reduce their contribution rates under the experience rating system. So this is a case where the state would allow them to make additional contributions in order to reduce their tax rate going forward. From 2010 to 2019, the company's total contributions to the state unemployment compensation amounted to $18,135. We're going to need that information because that's part of the total contribution. So we've got from, what does it say, from 2010 to 2019, it was 18,135. All right. There's more to this problem. We've got to do an additional calculation on those contributions. The contributions of each employer are credited to an account maintained by the State Unemployment Compensation Commission. The account is credited with contributions paid into the account by the employer and is charged with unemployment benefits that are paid from the account. Starting January 1st, 2024, the contribution rate for all employers in the state will be based on this tax rate schedule. So again, this is just an example of what that schedule might be. It would be different, state by state and probably year by year as well. But this is ultimately, once we find that reserve ratio, we're going to apply it to that table. All right, so the annual payroll for calculation purposes is the total wages payable during a 12-month period ending with the last day of the third quarter of any calendar year. Again, this is just unique to this problem. There might be, it might be January to December in some states where they make that calculation. In this case, what they're doing in order to determine the total payroll, which we're going to need in order to find the average total payroll, they are starting with the fourth quarter of one year and then going through the first 3 quarters of the next year to get the 4 quarters, okay? Not going January to December, but going from October to the end of September. And it's the average of the last 3 annual payrolls. Again, that's unique to this problem. The state may use an average of different number of years. Maybe it's 5 over the last 5 years, or 4 years. The student tax rate for the year is computed using the information available as of September 30th of the preceding year. The schedule below shows the total payroll and the taxable payroll for the calendar years of 2020 to 2023. All right. Unemployment benefits became payable to the company's qualified unemployed workers on January 1st, 2010. So that's when the business started. That's the beginning of their unemployment benefits history, January 1st, 2010. Between that time and September 30th of 2024, total benefits amounting to $23,194.15 were charged against the employer's account. All right, so we've got, so these are our contributions. We have to calculate what our contributions were from 2020 to 2024, but our benefits they've given us here for the entire year, $23,194.15. That's actually our step 2, so let's just write that down. We've got to find what our benefits. So $23,194.15. So the total, and they're giving you some hints here, and I think in the problem that you have, they give you these hints as well. First, you're going to total each year's taxable payroll. Using those numbers and pseudo rate, you can figure out how much has been paid into the reserve from 2010 to 2023, because we've got to find 2020 to 2023. We have to find out what that is, but we're going to have to calculate it. deduct the benefits paid to get the balance in the reserve account, compute the rate by dividing the balance in reserve. Okay. So, we have to find, we've got this number here, benefits paid. We have to determine how much the contributions were from 2020 to 2023 here, and add these two together to get our total contributions that were made. They could have made our lives easier and just given us everything, but they want you to do some math here. We've got the benefits paid, but then we've also got to calculate what the average total payroll is in order to get this ratio. Okay, so the first thing we want to do, let's calculate the contributions. Did they give us a tax rate? Okay, 3.7. All right, so that's their tax rate. Now we have to add up what their taxable payroll was during this time period and multiply it by the tax rate. Now it's important that you use just the taxable payroll because in order to determine the contributions, that's what they would have used in all of their reports, right? They would have just calculated using that taxable payroll, not the total payroll. So we're going to take our times the rate here to get that. All right. So we're just going to add all these up. 12,000. Again, this is where if you like spreadsheets, that would be handy. No, we're going to use that when we determine the average. We're going to start there. For this, we're going to use all the quarters. Okay, and we don't need to get it on a quarterly basis. We just need the total payroll, multiply it by the tax rate. If the tax rate had changed, though, you bring up a good point. If the tax rate had changed in one of these years, so maybe they had 3.7% in 2020, and that is going to apply to the annual, like the calendar year for that tax rate. Like their tax rate, we're determining the average payroll starting here so that starting in January, they're gonna get, that calculation is gonna be made to determine what the tax rate is. But if that tax rate was 3% for one of these years, then we would have to apply a different tax rate for that period of time. They've made it easy for us. We're just gonna use one tax rate, okay? So we're gonna take the taxable payroll. Sorry, I have to start over now. Does everybody see where I'm getting these numbers from? Okay, so our taxable payroll, 175,600 times 3.7%. So this is the total amount of contributions that they would have made over that period of time. So 6497.20. And then we'll sum those two up. 18,135. 24,632.20. And again, I apologize to those of you on that side of the room. Hopefully you can see. Can you see around the? Okay. Good deal. Okay, so we've got our contributions and we've got our benefits paid. Now we have to calculate what our average total payroll was over this period. So that's step 3. This is where we're going to start with the fourth quarter through the third quarter. Okay, so for 2020, we're just actually going to ignore these first 3 quarters because we need the three years prior. So that would be, this would be our current year, and then the second year would cut off there, and then the third year would cut off here. So we need 3 years. We're gonna call that first year 2021 because it ends in 2021. And then we need 2022 and 2023. All right. And then we're gonna average those out. So we're gonna start, again, this time we're gonna take our total payroll amount, not our taxable amount. 13,000. Does everybody see where I got those numbers? These are the numbers I used: 13,000, 11,000, 11,500, 12,750. So 48,250 for the first year. And then the second year. 5450. And then the last year, 14,000. Did I get that right? 42,650. We'll total those and divide it by 3. $184,000. Did I get that right? Nope, something's wrong. Oh, maybe it is. Is that right? I'm gonna do it again. Entered something wrong. 8250 plus. All right, that's way different. 48,250. Is that what everybody else is getting? Yeah. That sounds a little bit more. Yeah, it doesn't make sense. 141,350. And then we divide it by 3 to get our average. 47,116. 67. All right. So now we have our 3 factors in order to complete our equation up here. All we have to do is plug it in. Step 4, reserve ratio calculation. All right, so we're going to take our, and I'm sorry, can everybody see this low? Apologize. So our contributions, 24,632.20 minus our benefits paid, 23,194.15 divided by our average annual payroll, or average annual total payroll, 47,116.67. And you just do the math. So 24,632.20. Decimal there, sorry. Minus 23,194.15 divided by 47,116.67. 0.0305. This is our reserve ratio. Then we go up to our table, and it says contribution, if the reserve ratio is in this range, this is going to be our contribution rate. So it's between 0 and 7.9%, it's 3.05%. So our contribution rate for next year is going to be 5.5%. Okay. Now the second part of this question, well, does anybody have any questions about this? Lots of steps to follow in order to get there, but just remember, so if you've got that that equation, you know what the factors are that you need to find. And just take them one at a time. Determine what they are one at a time. Benefits paid was easy because they gave that to us. All right, so remember, if employers make additional contributions, they're able to adjust this rate so that their ultimate tax rate might be lower. So if they can get their reserve ratio up to 8% instead of 3%, then they can lower their tax rate to 4.5%. So that's what the second part of this question is. So the rate for 2024, if $2,000 of additional benefits had been charged by mistake to the company. All right, so if there was a mistake that had been made, and instead of the benefits being $23,194, they were $25,194, what would that reserve ratio be? All we're going to do is plug in that new number to the equation. So right now, let's see. Oh, sorry. So contributions the same, 24. 632.20. So this is phrased a little bit differently. We can see like how much, maybe the next part of it is how much do they need to contribute? If they can contribute more, how much do they need to contribute in order to get that percentage to the 8% in order to reduce their rate, and then we can see if it's worth it. All right, so 24,632. I'm sorry. Yes, minus 25,194.15. So now we're in negative territory. Divided by the same average payroll, 47,1667. You can probably imagine this is now going to be a negative number. But we'll do the math anyway, just for fun. So 24,632.20 minus 25,194.15 divided by 47,116.67. So now we're at negative 1.1% or 1.2%. And of course, according to the table, if the contributions fall below the benefits paid, they're now at 7%, which is what happened because their contributions are now that. All right, so let's see how much, just for fun, because math is fun. Let's say we want to get to 8% so that we can get our contribution rate down to 4.5%. How much additional in contributions do we need to make? Well, what we can do is, now we know what our reserve ratio is that we want, 0.08. We don't know what our contributions are, so that's going to be our X, minus benefits paid, 23,194.15. Remember when you did all that math review at the beginning of the semester? That's why they do that. That's why we do that. Divided by our average annual payroll, 47,116.67. Now we're just going to solve for X. All right, so let's multiply both sides. So 0.08 times 47,116.67. So, and we get with X minus 23,194.15 equals, we multiply both sides by the 47,116, 37,69.33. And then we just solve for X. We're going to add 23,194.15, 26,963.48 is what they need their contributions to be in order to get their tax rate down to 4.5%. Right now, their contributions are 24,632.20. So if we take the 26,963.48 minus the 24,632.20, you can see how much additional contributions we need to make. $23,31.28 additional contributions would need to be made. Now we want to see, let's play around and see if it's worth it to make that additional contribution based on our tax rate savings. So before, and we'll say that we think in 2024 our payroll, our taxable payroll is going to be, well, what has it been in the past? Let's just say $40,000. That's pretty easy. So I'm going to erase this here. If we assume, so 2024 estimate is $40,000 for our taxable payroll. I know this is total payroll. We'll say taxable here. Let's multiply that by our tax rate that we have right now of 5.5%. So 40,000 times 5.5%, and then 40,000 times, what did we save? 4.5%. Obviously, we can just do this by 1%. But we'll do this out. 2,200. If it's 5.5.
That's where you need to go.
1,800 if it's 4.5. Well, we'll get $400 in tax savings, but we will have paid $23.31. Not worth it, is it? Right. But in some instances, it might be worth it, depending upon what this chart looks like, right? And how much we have to pay in order to get there. You know, if we were almost there, if we were already at, you know, $26,000, then it certainly might be worth it to pay an extra $900, but it all just depends on, you know, how that calculation pans out. I know that's taking this problem a step further. Questions? Again, this is one of those problems that when students get to it in their homework, I get a lot of questions on this particular problem. So that's why I want to go through it in the class. No questions? Does it make sense? Those steps? I think they kind of give you, well, they give you the hint here of what those steps should be. All right. Let's take a look